Right now, the US stock market looks unstoppable. Every day, headlines scream about new record highs, tech companies adding billions in market cap overnight, and retail investors piling in with the belief that stocks only go up. On the surface, it feels like we're living in a golden era of wealth creation. But if you take a step back and look closely at the numbers, and the trends and the behavior driving this rally, you'll start to notice something concerning. Valuations are stretched beyond reason. Companies are being priced at levels that their earnings can't justify. And more people are investing not because of fundamentals, but because of hype. History tells us that when markets behave this way, the outcome is rarely smooth. What we may actually be witnessing isn't sustainable growth. It could very well be the making of a bubble. And bubbles always come with a painful cost once they burst. The first thing we need to recognize is that valuations are no longer tied to reality investment. When you look at the price to earnings ratios of some of the most popular companies, they're sitting at levels that historically have signaled extreme caution. In many cases, these stocks are trading at multiples far beyond what their businesses can generate in profits anytime soon. It's almost as if the market has stopped caring about earnings altogether and instead is pricing stocks based on future dreams that may never materialize. This is the hallmark of a bubble, when the story and the hype surrounding a company matter more than its actual financials. If you go back in history to the dot-com era, investment, the same pattern emerges. Companies with little or no profits were valued in the billions simply because investors were convinced the internet would change everything overnight. The internet did change the world, but it didn't justify those extreme valuations, and the correction that followed wiped out trillions in wealth. Today, we're seeing echoes of that moment. Companies with no clear path to profitability are commanding valuations larger than long, established businesses with decades of proven cash flow investment. Investors justify these sky-high numbers by pointing to future growth or disruptive potential, but growth doesn't always arrive in the way people expect. Even strong companies can stumble when their stock price is priced for perfection. All it takes is one earnings miss, one regulatory hurdle, or a shift in consumer demand, and suddenly the stock no longer looks untouchable. Another critical point is the speed at which valuations are climbing. Stocks aren't just appreciating slowly over time, they're shooting up in days or even hours after announcements, partnerships, or viral attention. This parabolic movement is rarely sustainable. Healthy markets rise steadily as businesses expand and earnings compound. What we're seeing now is a level of acceleration that outpaces fundamental growth by miles. When prices disconnect this dramatically, it's only a matter of time before gravity pulls them back down. It's also worth considering that much of the current market enthusiasm is built on momentum rather than analysis. Investors aren't carefully evaluating balance sheets or forecasting realistic earnings. They're chasing whatever's trending. This herd behavior inflates valuations even more because people are buying not out of confidence in the business, but out of fear of missing out. The more people pile in, the higher prices go, and the cycle feeds itself until reality eventually intervenes. When fundamentals are ignored and valuations are driven by speculation, the system becomes fragile. Even a small negative event can cause panic selling because deep down, investors know the valuations were never justified in the first place. The higher the stock price climbs without support from earnings, the further it has to fall once the excitement fades. That's why this stage of the market should make investors cautious. Investment. One of the biggest drivers behind the current surge in stock prices is not just institutional money, but the overwhelming presence of retail investors who are entering the market at an unprecedented pace. Investment. Many of these individuals are new to investing, drawn in by social media trends, online forums, and short clips promising quick riches through the next big stock. Platforms that allow free trading have made it easier than ever for anyone with a smartphone to start buying shares. And while this accessibility is a good thing in theory, it has also created an environment where decisions are often based more on hype than on research. Instead of analyzing a company's financials, cash flow, or long-term strategy, many are simply asking, investment. What's everyone else buying? And following the crowd. This fear of missing out is a powerful force, and it's causing valuations to rise well beyond sustainable levels. The problem with this behavior is that it transforms the stock market from a place of long-term wealth creation into a speculative casino. When investors are buying because a stock is trending on social media, investment, rather than because the underlying company is fundamentally strong, the market becomes disconnected from reality. Viral stories about people doubling their money overnight or turning small accounts into fortunes fuel the cycle further, convincing others to jump in. Investment. That makes a good investment, but what often doesn't get highlighted are the countless investors who buy at the peak, only to watch their investments shrink dramatically once the hype cools off. Investment. This imbalance between the success stories and the hidden losses creates a dangerous illusion of guaranteed gains. Another factor amplifying this trend is the gamification of investing. Investment. Many platforms have deliberately made trading feel like a game, with confetti animations, leaderboards, and instant feedback loops. This design encourages frequent buying and selling. Investment, which is the opposite of disciplined investing. The constant stream of dopamine from quick trades pushes people to act impulsively, chasing every new trend without understanding the risk. Investment. While this might make the market feel exciting, it strips away the very foundation of investing: patience, research, and strategy. When millions of people are operating under these conditions, bubbles inflate faster, because everyone is chasing momentum rather than value. It's also important to acknowledge that many retail investors are putting money into the market that they cannot afford to lose. With savings rates low and the cost of living rising, there's a growing desperation to make money work harder. This desperation often leads people into high-risk trades without fully grasping the downside. When markets rise, it feels like a winning strategy, but when volatility hits, the same investors face devastating losses that could take years to recover from. What began as a way to build financial freedom can quickly turn into financial ruin if the timing is wrong. Ultimately, retail-driven momentum adds layers of fragility to the market. It creates sharp, unpredictable swings and drives valuations higher than they should reasonably be. While this wave of participation shows how much interest there is in investing, it also highlights how easily emotional behavior can distort prices. The current state of the stock market cannot be understood without looking at the role of monetary policy and interest rates over the last several years. For an extended period, interest rates were kept at historically low levels, and this created an environment where traditional safe investments such as savings accounts, treasury bonds, and certificates of deposit provided almost no meaningful return. Investors who wanted their money to grow were effectively pushed into riskier assets, and the stock market became the primary destination. This flood of capital inflated stock prices, not because companies were suddenly more profitable, but because there simply weren't many other places to earn a return. The combination of cheap borrowing costs and abundant liquidity set the stage for valuations to soar well beyond what fundamentals could justify. Cheap money also meant companies themselves could borrow at minimal cost, fueling aggressive stock buybacks and expansion plans. When businesses use borrowed money to repurchase their own shares, it reduces the number of shares in circulation, artificially boosting earnings per share and often driving the stock price higher. While this can create short-term value for shareholders, it doesn't always reflect genuine growth or improved business performance. And instead, it becomes another way in which valuations get stretched by financial engineering rather than by true productivity or innovation. At the same time, the central bank's policies of injecting liquidity into the system added more fuel to the fire. Stimulus checks, quantitative easing, and government spending provided consumers and investors with extra cash, much of which found its way into the market. Retail investors, empowered by these funds and supported by easy access to trading platforms, poured money into stocks with little regard for valuation. Investment. The collective effect of all this liquidity was a tidal wave that lifted almost every sector, making even struggling businesses appear attractive simply because money had to go somewhere. However, the problem with this artificially supported environment is that it creates a distorted sense of stability. Investors begin to believe that markets will always rise because conditions appear so favorable. Low interest rates encourage leverage, and when investors borrow to buy more stocks, they amplify their potential gains, but also their risks. The system becomes incredibly fragile. Investment, as even a modest shift in interest rates or policy can send shockwaves through every corner of the market. A slight increase in borrowing costs can make leverage positions unsustainable, forcing rapid sell-offs that cascade into broader declines. Every bubble throughout history has ended the same way, with a correction that wipes out wealth faster than it was created. The danger with the current environment is that valuations are already stretched. Investor confidence is overly dependent on continued momentum, and the smallest disruption could trigger a chain reaction. Markets thrive on stability and predictability, but when prices climb far beyond fundamentals, they leave no cushion for bad news. A single earnings report that misses expectations, a sudden spike in inflation, or a change in interest rate policy can act as the pin that pops the bubble. The result is not usually a gradual decline, but a sharp, painful correction that punishes those who entered the market at inflated levels. What makes corrections so damaging is not just the decline in stock prices, but the psychology that follows. Investors who once believed that stocks could only go up suddenly realize how exposed they are. Fear replaces optimism, and the same people who rush to buy at any price now rush to sell at any cost. This behavior accelerates the fall, pushing prices down faster than fundamentals would normally dictate. Margin calls only worsen the situation, as leveraged investors are forced to liquidate positions, creating a downward spiral. The speed at which wealth can vanish in such an environment is staggering. Investment. And history is full of examples where years of gains were erased in a matter of months. The risk also extends beyond just stock portfolios. When bubbles burst, the broader economy often feels the impact. Companies that were relying on inflated valuations to raise capital suddenly find themselves unable to do so. Layoffs, cost cutting, and reduced investment follow, spilling into job markets and consumer confidence. Ordinary people who were drawn into the market by stories of easy money may face financial ruin, and the ripple effects can stall economic growth for years. Right. What started as excitement in the stock market turns into a drag on the entire economy. Another point to consider is that bubbles create a false sense of security that delays prudent decision making. Investors feel comfortable taking on higher risks, believing that conditions will always remain favorable. When reality sets in, it often catches them off guard. Those who built their financial plans on the assumption of endless market growth are left scrambling, while more cautious investors who stayed disciplined are better positioned to weather the storm. That the difference between these outcomes often comes down to recognizing the signs of a bubble and preparing accordingly, rather than ignoring them in pursuit of short-term gains. Investment. The harsh truth is that no bubble lasts forever. The higher the market climbs on speculative excess, the further it eventually has to fall. For investors, this means the current period should not be seen as a guarantee of future prosperity, but as a warning to reassess risk, remain disciplined, and avoid being swept up in the excitement that has historically ended in painful lessons. The longer such easy money policies persist, the more they condition investors to expect them as the norm. This creates complacency, where risk management takes a backseat to the assumption that central banks will always provide support. But once inflation pressures build or policymakers decide to tighten financial conditions, the safety net disappears. Suddenly, valuations that looked manageable under a regime of near zero interest rates become unsustainable when borrowing costs climb, and that's when the fragility of the system is exposed.